You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. The Fed's balance sheet has grown from under $1 trillion before the financial crisis to nearly $7 trillion today. What began as an effort to stimulate the economy during the financial crisis and pandemic has now become a lingering concern for critics like Kevin Warsh, who believe the big balance sheet increases inflation and distorts the useful market signals of interest rates. On today's episode, we talk with Jeff Lacker, president of the Federal Reserve Bank of Richmond from 2004 to 2017, about what drove the Fed to grow its balance sheet so much, the impacts of QE over the last 20 years, and how to shrink the balance sheet under the Fed's current regulatory and policy regime. Stay tuned. Coming up soon, our interview with Jeff Lacker, but first, a quick market update. Crude oil prices plummeted and treasuries rallied last week after President Trump announced a two-week ceasefire with Iran. Talks last weekend in Pakistan did not lead to any successful agreement, but investors are cautiously optimistic that both sides are earnestly working towards longer-term peace. The rhetoric from both sides has oscillated between maximum hostility and declarations of imminent peace. Meanwhile, ship traffic through the Strait of Hormuz has come to a virtual standstill, and the U.S. instituted its own blockade of ship traffic so that Iranian ships could not continue exporting oil. West Texas Intermediate is trading close to $92 after reaching as high as $116 last week. The February PCE last week confirmed pre-war inflation was stubbornly higher than the Fed's 2% target. The core PCE deflator rose 0.4% and 2.9% year-on-year. Also last week, the March CPI gave the first look at how the war has impacted consumer prices, rising 0.9% and 3.3% year-on-year. The Fed targets the core PCE deflator, but the CPI tends to be published a few weeks before the PCE, so will be a helpful indicator for how higher energy prices are passing through to other goods and services. The Treasury market was much more responsive to war developments than any of the data released over the last 2 weeks. The bond market is signaling expectations for Fed policy to stay indefinitely on hold, but with much less risk for rate hikes than what traders priced in a few weeks ago. The 10-year Treasury is tethered close to 4.30% as traders weigh the reflationary aspects of the war with the detrimental impacts on growth. We expect long-term Treasuries to stay range-bound until investors observe a concrete update on the war's trajectory. The minutes from the Fed's March meeting were largely unsurprising, affirming last month's press conference that said officials were patiently on hold until they have a better idea of how the war will impact the two sides of the Fed's dual mandate. Several public appearances from FOMC participants the last 2 weeks echoed this perspective with varying degrees of worry about how much higher energy prices will pass through to core inflation. That's all for the market update this time. Now our interview with Jeff Lacker. Our guest today is Jeff Lacker, former president at the Federal Reserve Bank of Richmond from 2004 to 2017. Jeff, thanks for coming on the podcast.
My pleasure.
Our topic today is the Fed's balance sheet, why it's become so much bigger over the last 20 years, and how the Fed may reduce its size with Kevin Warsh as chair. Now, if you look at a time series chart of the Fed's balance sheet, it was just under $1 trillion in August 2008, and now it's about $6.6 trillion. So Jeff, to start things off, how does the Fed buying up securities even theoretically fit into its dual mandate of price stability and maximum employment? What's their motivation behind doing this?
The Fed has monetary liabilities. It has a lot of paper currency, hand-to-hand notes that it issues. And in addition, the banks have reserve accounts with it. Those two together make up the monetary liabilities of the Fed. And that's the main way the Fed influences economic activities. It used to do was make bank reserves scarce enough that it drove up the overnight interest rate on loans between banks of reserve balances. That's the Fed funds rate. it gained authority in 2008 to pay interest on reserve account balances. And so it pays interest and it provides a big enough supply of reserve account balances. Like the equilibrium price is pretty much the interest rate on reserves. Now, there's some wrinkles about that. We can go into that. I know you've had an episode about the withering federal funds market. But for this purpose, this is that's a sideshow. The Fed funds market is a sideshow, not really essential. So once it's done that, it's set monetary policy, the classic way you think of it, the central bank setting the nominal overnight interbank interest rate. So beyond that, what can it do to stimulate economic activity? One approach is to increase monetary liabilities even more. And this would crowd out other things in the balance sheets of the public and the banking sector, force them to shift out of other things and into the new monetary liabilities you're providing. And then the other things would go down in yield. So it would sort of force them to move out the spectrum of other assets, and that would stimulate activity. That channel, which is called portfolio balance. So if you picture the Fed increasing its monetary liabilities just by holding treasury bills, short-term treasury securities, imagine that's all it has on its balance sheet, and it expands monetary liabilities. Well, after it's set the size of monetary liabilities it has out there, it can take another step and sell some of the treasury bills and buy longer-term treasury securities. And the theory is, under some economic models, that depresses the yield on longer-term securities because it's buying up those longer-term securities. They get scarcer. Those longer-term securities go up in price, which depresses their yield. And the theory is that that passes through to the rates of return that private borrowers have to pay for longer-term loans, and that stimulates economic activity. That, in the nutshell, is kind of the two theories behind the effect quantitative easing might have to stimulate economic growth. It's controversial because in some models, there's no effect at all. That kind of maneuver is subject to what's called the Modigliani-Miller theorem, in which it's sort of inessential and doesn't really have an effect on any yields at all. So you have to have some frictions in the model to get it to do that. And that's where the controversy comes in.
We'll follow up on a lot of that in just a bit, but I do think there are 2 points I want to elaborate on just quickly before we go on. So the first is what you alluded to in the beginning, that shift between the scarce reserves regime to what is now an ample reserves regime. So if I understand correctly, before the financial crisis, if banks wanted to kind of have this unexpected liquidity access because, they have unexpected needs, they would go to something like the discount window, pledge collateral, and then that's how they would meet those short-term liquidity needs. But now, in an ample reserves regime, banks have $3 trillion in reserves at the Fed, and they access those as sort of a buffer for these unexpected liquidity needs. And the Fed pays them interest on those reserve balances so that they have an incentive to keep them there. But it is also part of this regulatory approach and new Fed approach to have $3 trillion in reserves at the Fed.
Yes. So the way I think about the difference between scarce reserves and ample reserves is that for any commodity, and like interbank overnight loans of Fed funds is a financial instrument in some sense, there's a supply curve and there's a demand curve. There's a total supply of reserves, and then there's a market price for borrowing them overnight. And when the total supply is low, the price is high. The price in this case is the rate on interbank loans minus the opportunity cost is you could hold the reserves at the Fed. Now, in the old regime, you could hold reserves at the Fed and they'd earn zero. When interest rates were 5%, the Fed made reserves scarce enough that it drove interest rates up to 5% or 5.25% or 4.5% or whatever the target was. It would do that, and banks would equate at the margin the value of borrowing to have a little more extra reserves versus the cost of not having extra reserves, which was the risk that at the end of the day, there's a sudden unexpected withdrawal and you have to, either go to the discount window or incur an overnight overdraft. So with the supply large, there's going to be plenty of banks around that have reserves, don't need the reserves they have, and are willing to lend them. And that'll drive the price down to the floor. And the floor in the old regime was zero. If the desk missed and added too many reserves, it would crash the funds rate. And it didn't take much. A couple of billion would drive it down on a Wednesday night. What they do now is they pay interest on reserves. So they're driving the equilibrium interest rate in the market for overnight Fed funds between banks, driving that down to the interest rate on reserves. And reserves are so large now that virtually no banks borrow from any other bank in the interbank market. So that market is moribund, I think would be the good word for it. Dormant, maybe a better word. So here's the question. How much do you need to drive down, to go down that demand curve far enough to get interest rates close to the interest rate on reserves? And this is murky and controversial. This guest you had on once, Bill Nelson, documented that you can look at spreads in the repo market and get a measure of this. And by that measure, the Fed is sort of looking at that last fall and decides, all right, we're running off reserves. We're engaged in quantitative tightening. We're selling off assets and reducing reserve balances. And they see that that spread goes up a few basis points. And they decide, we're on the upward sloping part of that demand curve. We better stop here at $3 trillion in reserves. Now, Bill pointed out that there's sort of a ratchet effect, that when they increase reserves, then a lot of banks sort of adapt their operations and adapt their market making activity and their reserve strategy or holding strategy to a large amount of reserves in the market and the way that interest rates behave. But then when reserves fall down, if they don't adapt again, there's a little bit of stickiness and spreads go up. But if they push through that, if they moved on through that and kept reducing reserves, banks would adapt again. The ratchet would go in reverse and you'd see spreads fall again. You wouldn't see a steady increase in reserves. The Fed's choice here and stop reducing reserves at about $3 trillion in reserve balances. That choice reflects a theory about the shape of the demand curve and its stability over time, that it wouldn't continually shift inward as reserves fell. So that's kind of where the controversy lies about this recent move.
I think that's all really helpful and gets to a question that I'll have later, which is about how to shrink the balance sheet given kind of where the status quo is. But I do want to follow up on one thing from your previous answer, which is how QE differs from the Fed funds rate. So the Fed funds rate is this overnight lending rate, but QE is trying to depress long-term borrowing rates. And essentially, they're both trying to stimulate the economy in different corners of the financial universe, but at different angles.
Yeah, that's right. So the idea plays off the notion of a term premium, a difference between actual long-term, like say a 10-year interest rate, and what markets believe the short-term interest rate, say a sequence of 1-year interest rates, is going to be between now and 10 years from now. So without risk considerations, the 10-year rate should equal the accumulated expected 1-year rates over that time horizon, like the 1-year rate expected 1 year from now, 2 years from now, 3 years from now, and so on. There's risk, however, because if you want to borrow 1 year, 1 year, 1 year, or invest 1 year, 1 year, 1 year, and keep rolling it over, you expose yourself to the risk that 1-year rate fluctuates. At the 10-year horizon, you can lock up a 10-year yield. So there's a risk premium built in there. It can be positive or negative depending on various things. And the theory is that the Fed can depress that risk premium by making the supply of longer-term risk-free investment vehicles like the 10-year Treasury scarce relative to the demand for 10-year securities.
Take us into the deliberations of the FOMC in late 2008 as Fed officials were deciding whether or not to start QE. So you have Ben Bernanke as chair, who's academic career has more or less been motivated by trying to avoid a repeat of the Great Depression, but at the time, it wasn't clear how bad the situation might get and what QE would do, good or bad, to the financial system. How are committee members thinking about the trade-offs, the costs and benefits of this policy approach at the onset of the financial crisis?
The question about QE came up going into November and December of '08. And so this is after a fair amount of financial market turbulence and a fair amount of policy maneuvers. The TARP bill was passed, which gave the Treasury $700 billion to inject into banks. You had banks kind of lose access to capital markets because the Treasury injected capital and they couldn't raise private equity because no one knew whether the government was going to inject more and dilute, new equity holders. So you had a pretty chaotic situation. And in that situation, it was in November and December that the federal funds rate got to effectively zero. In December, we started talking about QE in a serious way, sort of on a somewhat separate track. In November, the board in New York decided to announce that they were going to buy a large quantity of mortgage-backed securities issued by Fannie Mae and Freddie Mac. That was done out of consideration of basically those mortgage-backed securities were having some trouble in the market. Their prices were depressed because of the risk in the housing market. December and when we adopted QE in January, there was a fear that we overdid it. It would raise inflation. Moreover, there's a fear that it would increase inflation expectations, that people would be fearful that the Fed would do too much, go too far, and spark inflation. In addition, there was this feeling that it's not obvious how effective these are going to be. Kind of the standard thinking had been that, the effect would be minor, maybe a couple of tens of basis points on longer term yields. Is that worth doing? Is that worth running the risk? On the other side of that was the feeling that the situation was so dire, the economy was contracting so rapidly that we had to try everything that could conceivably aid the situation. In 2009, I supported quantitative easing program with Treasury securities, but I opposed mortgage-backed security purchases because to the extent we purchased mortgage-backed securities instead of Treasuries, then we were going to have less of an effect on Treasury yields, and that was going to raise borrowing costs for non-housing borrowers. So it just seemed like credit allocation to me, and I didn't see the rationale for that, especially since we were in a situation where we had built so many houses, and the problem the economy had is that we built too many houses, or we built houses way before we needed them. So it wasn't obvious that stimulating housing was like a really strong motivation for intervention in the housing market.
It's easy looking back. I mean, even in hindsight, Fed policies at the zero lower bound, you're not sure where the bottom is going to be for this downturn. You might as well throw the kitchen sink at it. Is quantitative easing, though, something that the Fed had done during previous crises, or had other major central banks done something like this, bought up trillions of dollars of securities for their balance sheet, or was it kind of radically new thinking?
No. So the major example was Japan in the late 90s and 2000s. They dramatically expanded their balance sheet. They didn't I don't know if they call it quantitative easing or not, but that was a widely remarked upon in the macroeconomics literature at the time. It was sort of controversial. There were sort of different interpretations. When Japan hit the zero bound, and after it was there for a decade or so, there were some economists who pointed to their anemic real GDP growth rate and said, well, this is a disaster. They hit the lower bound and they can't stop. And, they had like deflation of 1% a year. They had kind of really low or slightly negative inflation for a long time. They said, look, this is a disaster. We have to avoid this at all costs. But other economists pointed out that their population growth was way lower than ours. And if you adjusted for population growth, their real GDP growth wasn't that bad. It wasn't that much of a disaster. An inflation rate between -1 and 1 seemed not that terrible. So that was the big precedent. That figured into the debate as well. A lot of people raised the specter of Japan as a rationale for taking any aggressive action that seemed plausible.
Yeah, it reminds me a couple Fed governors recently, in response to questions about the potential big increases to structural unemployment from AI, they said, essentially, listen, monetary policy is not the solution to everything. And sometimes I think people need to remember that there's perhaps a motivation for central banks to keep going until they get the outcome they want, but not everything can be solved by monetary policy. We'll get into the risks and downsides of these asset purchases next, but before that, looking back now, do you think the Fed's purchases over the last 20 years have had their intended effect? Do they stimulate investment through longer-term interest rates?
I don't think they did much, really.
Why is that? I mean, if we worry so much about financial conditions and the 10-year treasury rate is lower, I mean, even if it's inorganic and sort of too much intervention in the price system, what do you think went wrong where investment wasn't stimulated here?
The key to the theory underlying quantitative easing having significant or noticeable real economic effects is impediments to arbitrage between the market for 1-year Treasury securities and the market for 10-year Treasury securities. That never struck me as terribly plausible. It's something it's just sort of taken as a postulate in the theoretical literature on this, and people run with that. I'm not aware of any serious work to actually go out and look in the markets and say, all right, who is it that invests in the 1 year and doesn't have access to the 10-year market or doesn't play in the 10-year market? I mean, everyone you think of, hedge funds, banks, broker-dealers, if they're in the treasury market, they're capable of going up and down the curve. I never bought that. And so I think that the empirical literature that attempts to measure the effect of quantitative easing announcements on yields, relies heavily on the announcements. And whenever we announced a program, we were doing two things. We were telling people about the program, but we were also, by enacting this program and announcing it, communicating about what we thought about the current state and future state of the economy. It always conveyed bad news. You always have this identification problem of disentangling the effect people expect to have on future, on this risk premium and what they expect on future policy and future economic outcomes.
I guess that's true. When the Fed is easing policy, they're saying, hey, we want you to borrow, we want you to invest more because the economy is not doing very well.
Exactly, right. So it's hard to disentangle those two effects. Another reason it didn't really have an effect, after 2008, liquidity was a major source of concern in the banking industry and among bank supervisors. Banks began holding liquidity buffers that were much larger than was typical, say, in 2007. And the buffers were a combination of things. So bank reserves were a big part of the buffer, but also short-term Treasury securities and short-term debt of Fannie Mae and Freddie Mac. So by 2009, Fannie and Freddie were in conservatorship run by the Treasury. So they were effectively part of the government. So basically, they'd hold these liquidity buffers, and the magnitude of total banking system reserve account balances, I don't think was ever more than 40% of the total liquidity buffer that the banks held. So let's say we bought short-term Treasury securities, we would increase reserve account balances, but we would take short-term Treasury securities out of the system. If we took them directly from banks, that was a wash. It just replaced one thing in their liquidity buffers with another. And they didn't really have strong reasons to prefer one category of these liquidity buffer assets over another, except for some minor sort of technical things. Up until we swamped the total liquidity buffers of the banking system, reserve account balances aren't going to affect bank behavior that much at all. And I think that's another reason why it never really had much effect. It didn't really cause inflation. And, since then we've developed, kind of good models of this effect.
By the time the third round of QE comes around in 2012, you formally dissented. And what was your thinking at that time?
So at that point, the debate had to do with labor markets. There were essentially two perspectives on this, and people arrayed in between these two broad perspectives. One is that The unemployment rate was high. I don't know, in 2012, what was it, about 7 or 8%? It had come down only very slowly. It peaked at over 10% in 2010, I think, 9 and 10. It only came down slowly, and everyone was disappointed with how slowly it came down. From one point of view, full employment should be like 4.5 or like 5% unemployment rate. And people predicted that because the contraction was sharp, the recovery ought to be sharp. And that didn't turn out to be the case. The feeling was that there was deficient aggregate demand. If we'd only stimulate aggregate demand more, we would get more spending and better labor market conditions. The other point of view is that what was holding back the labor market from healing was the fact that it was just going to take time. So if you look at post-war expansions after recessions, the unemployment rate seems to come down at about the same rate after every recession. So take the peak unemployment rate, reach a recession, and look at the slope downward. It just comes down at the same rate, which suggests there's some costly adjustment process that's involved. And if you think about what happened in the great financial crisis, we lost like millions of jobs in housing construction related industries. So housing construction itself, but also building materials and some service sectors related to that. They were thrown on the labor market. We weren't going to build houses in the expansion. Housing wasn't going to lead the expansion out of the great financial crisis. That was for sure. We had more houses built than we really had demand for, need for. So it was going to be somewhere else. Well, where's it going to be? Is it going to be in healthcare, education? Is it going to be in manufacturing? So there was this adjustment process of deploying capital and labor in different areas, different industries. And that's a process that requires discovery. It requires, some advancing capital for that, lending for that, raising equity money, businesses forming, figuring out, new things to do. What is demand rising for? Where are the opportunities now to redeploy capital and labor? And that process was just going to take time. And in some cases, there were impediments of location. People were located in Michigan and the jobs were in Texas, say. In some cases, there were impediments involving skill mismatches, that people were, good construction workers or manufacturing workers, but jobs were in service sectors like healthcare, say. So the debate was like, what's going on in the labor market? And is it deficient demand, or is it an impediment to the adjustment, essentially the supply, or the demand for labor wasn't going to adjust rapidly in response to just flooding consumers and businesses with money to spend. That wasn't going to do the trick. That was the debate. That's why I dissented. I just didn't think it was useful. And I thought it sort of raised questions about exit and posed risks on that side as well.
The way that you've described QE, at least after the financial crisis, was that the positive impacts were pretty benign. And like you said, we didn't really get big inflation after the financial crisis either. So what are the risks or downsides from QE? I mean, the Fed's balance sheet has been this really popular villain for a lot of people in the macro space as long as I can remember. But if the positive impacts are kind of benign, does that mean the risks and costs associated with it are also somewhat small?
I think that the Fed's intervention in the Treasury market beyond just the bills market, the really short-term stuff, is problematic because it's episodic, it's hard to predict, and the fact that it's a possibility that's out there discourages the kind of market making that you'd like to see. It makes the market less robust than it otherwise would be. So in the pandemic, for example, the Fed bought a tremendous amount of Treasury securities. There was this dash for cash, and the Fed claimed that markets were dysfunctional and it was curing market dysfunction. What you'd like a market to do on its own is sort of heal itself. And the way that usually works is that there's a shock, something that causes a widespread questioning of or revision of views about the fundamentals underlying an asset. And that causes the price to change and people take actions as a result. Now, one of the things it does, so broker dealers that are in a market, making a market in something like treasuries, their decision to deploy capital and labor to that activity depends on their views about the path and volatility of prices. And if all of a sudden that activity looks a lot riskier, you ought to expect people to pull back from that. In addition to sort of investors changing their mind and pulling back. But what, you want is for some bottom feeders, people with contrarian views to kind of wait, and they see the price go down, they see an opportunity. They say, well, this has gone too far. I'm going to step in and kind of buy on the dip or buy on the plunge, and that kind of corrects the market. That's why, you don't see the equity markets going down 40% in one day. There's like a range of people out there with different views, and price goes down enough and some people with other views come in. Well, if the Fed could step in ahead of you and is likely to, if things go too far, it's going to reduce the return to putting aside dry powder to position yourself to be able to buy on the dip. And so it's ironically going to make markets more fragile if they expect the Fed to intervene on a basis that's not essentially profit and loss, on some non-economic criteria. And so that's what the Fed's ongoing engagement in the Treasury market really threatens to do, is to really erode market resilience. And so that's why I've advocated, and I did this in a hearing on the Hill yesterday, that the Fed ought to limit itself to Treasury bills. It can do monetary policy perfectly well just holding Treasury bills. And if you think about it, go back to this question of sort of the quantity of monetary liabilities of the Fed. Once that's set, if it's doing anything but holding Treasury securities, it's doing fiscal policy. So imagine it starts with a given amount of monetary liabilities, all backed by Treasury short-term T-bills. Suppose it buys longer-term bills. Well, it's selling T-bills to do that. The Treasury could do that. Or suppose it's making a loan, intervening in a credit market, acquiring some other asset, corporate bonds. They have to sell a Treasury bill to do it. The Treasury could do that. It's not monetary policy. It's not changing the nominal overnight interest rate in interbank markets. It would just be cleaner and more faithful to the charter of the Fed, the Federal Reserve Act, for the Fed to just limit itself to T-bills on the asset side.
I think this idea that the Fed's footprint is too big makes a lot of sense. And so to take one extreme, the Bank of Japan was so aggressive for a while in their purchases of Japanese government bonds that there was effectively no market for debt. I mean, they called it yield curve control. And we want interest rates to be this helpful signal in the economy so that we allocate capital efficiently. But to this point, something that former Fed Vice Chair Rich Clarida wrote about recently is that the Fed's share of the outstanding Treasury market right now is actually smaller than it was 20 years ago. So yes, the Fed's balance sheet is much bigger, but its footprint in the Treasury market is less intense than before the crisis. And of course, the explanation for that is that outstanding Treasury debt has become so big. But by this metric, the Fed is more of a passive participant in the Treasury market than it was before the crisis.
That goes back to, what capability do they have for influencing prices? I think over time, that intuition is correct. It's still capable, I think, in instances like March 2020, kind of preempting the way things go. You can see that in the corporate bond market with the announcement of its policy there. I think it's still a concern, even if the footprint is in some measured sense smaller. I think the growth of the debt is part of the reason this is a really crucial question, because you do want price discovery to work well in the Treasury market, because in some sense you want that feedback for fiscal policymakers to understand whether they've gone too far, whether the outlook for fiscal policy is unsustainable, whether market participants are confident in your ability to continue to repay the debt without resorting to inflation. And you want a clean market signal as a part of that signaling process.
Something you touched on before is about how the Fed has these massive liabilities on its balance sheet, and the counterpart to that is filling up the asset side. And, a part of independent monetary policy, for better or for worse, is that the Fed is reactive to the conditions around it. So the Treasury holds sometimes up to $1 trillion at the Fed in its general account. It's Treasury's checking account that is sort of its own liquidity cash buffer, depending on, expenditures and revenues seasonally fluctuating. If the Fed has $1 trillion in the TGA on its liabilities, what are they supposed to do for the assets other than buy up Treasury securities. And to your point, if they buy up T-bills, isn't that distorting the feedback loop of fiscal policy? If Treasury just wants to, have this massive issuance of Treasury securities, and then the Fed has no alternative than just buying them up to put on their assets, isn't that the same fiscal monetary policy, fiscal dominance?
The thing I have my eye on is the constraint that the Fed's acquisition of Treasury securities take place at market prices. I think that's an important discipline. It means that the Fed isn't just sort of handing over resources as a gift to the Treasury by overpaying for securities the Treasury gives it. So you want those purchases by the Fed to be at market, something that's demonstrably at market. And the way the Fed does this by piggybacking on auctions accomplishes that. I get worried when I hear rumors about asset swaps where the Fed transfers some assets to the Treasury in exchange for something or another. I mean, I think the danger there is the Fed has a lot of assets that are underwater at a market value, but it carries at par. So the temptation, would be for the Fed to kind of transfer them for some valuation monkey business to go on there that sort of circumvents this open market constraint.
Regardless of whether buying up these securities was a good thing overall, the balance sheet is the size today that it is. What is stopping the Fed from shrinking their balance sheet today? I think you alluded to some of the issues a bit before. If the balance sheet really distorts financial markets like we've been talking about, and inflation is a percentage point above its target, why don't they just sell off some securities, let them roll off, and everything seems to be solved?
What I think the view in the Fed is that the balance sheet at its current range isn't contributing to inflationary pressures. I think that it's deeply concerned about money market conditions, but I think it's confused about that. And I think it's called this, harkening back to a term William and Chesney Martin used. I think it's been mothering financial markets. The fact that it takes up funds through its overnight reverse repurchase agreement facility. So it's borrowing in the repo market, and then it's lending in the repo market via the standing repo facility. I think it's just a little strangely paranoid about movements in the repo rate. What happened last year is that the repo rate started rising relative to the interest rate on reserves to an extent that made it a little skittish. The background is this incident in September 2019 in which the repo rate spiked one day. There was a confluence of events that day that made funding in the interdealer market a little unbalanced. And so there was, sort of supply and demand. The price went up one afternoon. And it didn't cause any lasting harm to anything, really. But the New York Fed just stepped on the gas, intervened dramatically, ad hoc, sort of suddenly the next day to try and ease funding conditions for dealers. In the rhetoric it's used since then about that event, it's managed to pathologize something that never used to be viewed as much of a pathology. I mean, before the crisis, before 2008, repo rates would vary, all the time. No one really cared about the spread between the repo rate and the Fed funds target would get up to 20 basis points plus or minus. And it was never remarked upon. And at quarter end and at year end, there would be spikes in the funds rate away from the target that everyone understood were attributable to just the vagaries of year-end accounting, window dressing by some institutions, some funky little things. And somebody was willing to pay up for the value of having something on their balance sheet other than what otherwise would be there. I think the system, particularly New York Fed, I fault for this, has managed to pathologize money markets in such a way to sort of justify an sort of exceptionally interventionist stance towards markets. And I think that's what motivated this whole ample reserves idea. They've concocted this framework in which there's a fixed, stable demand for reserves that rises gradually as you fall below $3 trillion. And, repo rates kind of gradually rise from there. And they didn't want to get on the part of the curve where the funds rate was too high or repo rates were too far from the interest rate on reserves. It just doesn't seem plausible that that spread would rise rapidly, at 2 trillion or down to 1 trillion. It just doesn't seem plausible that the obvious arbitrage opportunities that would arise, were the repo rate to surge or, remain on a persistent basis very far above the interest rate on reserves, that the natural arbitrage opportunities wouldn't be exploited by, the institutions capable of standing up a repo desk, voting the capital to it going forward.
So in September 2019 and also the fourth quarter of 2025, you're saying the Fed misdiagnosed a liquidity crisis, and actually they should have just let these overnight funding markets play out instead of going back to increasing their balance sheet.
I think that's right.
So something you also said there was that banks have access to the discount window, the standing repo operations, as they've been rebranded now. But whether or not they should access those, there is a stigma, and it's easier said than done to just say, okay, banks, you don't need these reserves. You should just go and go to the repo market, right? I mean, how do we know that the repo markets are actually going to be self-correcting and we aren't going to have some sort of banking crisis that's exacerbated?
I just don't see where a crisis would occur. These are, repo is it's a pretty liquid market, pretty deep. It's where all the hedge funds put their money, and use their treasury securities, and fund themselves, and fund, basis trade, arbitrage between the futures market and the cash market. I just don't see where a crisis would come from apart from some bank that's underwater, and we don't have solvency problems in this sector these days. It just doesn't happen.
So what do you think then Kevin Warsh and the FOMC could do to shrink the balance sheet? Should they just let those securities roll off and the market will figure itself out? Or do you think it needs to pair that with other changes to policies?
I think it needs to craft a plan for reducing its asset holdings. It needs to be a predictable, steady plan, and it needs to communicate that to markets. It needs bank examination staff to understand what it's doing and understand the direction in which the entire market is going to be moving. It needs to ensure that a staff of examiners conveys to banks at sort of the examiner level, down in the trenches, what's expected to happen, that repo rates could rise relative to the interest rate on reserves. The system respects that going to generate trading opportunities, arbitrage opportunities, and it understands that. Also, there's a question of liquidity regulations, which I think have, to some extent, ossified bank reserve demands. And this is a situation where the regulations should be flexible enough that whatever's in your liquidity buffer is evaluated on sound objective grounds, and that examiners aren't exhibiting sort of habitual prejudices towards reserve account balances over T-bills and the like, and that's managed sensibly. There's always a problem here with things like liquidity regulations. They're like reserve requirements. The great macroeconomist Irving Fisher once, and this was in hearings for the Federal Reserve Act in 1913, he once opined that reserve requirements were like mandating that a certain number of life vests had to be carried on any passenger ocean liner. And moreover, to make sure they were available, they should be nailed to the deck. And of course, that was, sort of a sarcastic observation. If you think about it, the point is that, there's always this question, right? You've got a reserve. Do you deploy it or do you hold on to it? And the judgment about that is a delicate one that involves expectations, cost-benefit analysis, some finely tuned decision-making. And for that to be bound by a rigid numerical regulatory constraint kind of short circuits the whole purpose of having reserves on hand. If you're not going to use them, what do you have them for? What's this reserve requirement for if you don't sort of let people out from under them to use them when it's a dire enough situation? But of course, the whole point of having the regulation is that you don't trust banks to not hold less reserves than they ought to. You've taken something that used to be something that a firm could could do an economic cost benefit analysis on a day-to-day basis, and you've made it part of a negotiation between a supervised institution and its supervisors, which becomes sort of politically fraught and doesn't necessarily come out on purely economic ground. The political, public choice considerations at the supervisor level often come into play.
That life jacket anecdote from Irving Fisher is interesting. Sometimes I think of bank reserves like the minimum $1,000 that you have to have in your checking account. Like, technically, it's yours, but if you access it at all, there are penalties to it, and so it does kind of defeat the purpose. I want to close by asking what your sense is of appetite within the FOMC, not just, Kevin Warsh, assuming that he's confirmed as chair, but a critical number of the FOMC. Do you think they'll support shrinking the balance sheet? And if so, those rule changes that you just talked about, what's the sort of timeline that would be required for those to play out?
So the way the Fed works is what one persuades by mobilizing staff analysis. And here's what I've been saying about prospects for Kevin Warsh's tenure as chair. Success will depend on the effectiveness with which he engages the staff. Now, on the monetary policy side, interest rate setting side, that depends on the research staff, research and statistics, and monetary affairs staff. On this issue, it depends on the staff in monetary affairs, but also at the New York Fed, and mobilizing and directing and guiding towards a deeper consideration of those factors that last fall led them to stop quantitative tightening. I think if he could, bring in outside advisors to kind of help spark a, sort of a deeper dialogue and conversation within the system at the staff level about the feasibility of a smaller balance sheet and how the Fed might be able to operate perfectly adequately that way and meet its objectives. I think if he could do that and bring the staff analysis to bear on the question, he could help reframe everyone's perspective on that. And I think he could persuade the committee to go along.
Jeff Lacker, thanks for coming on the podcast.
My pleasure.
That was Jeff Lacker, former president of the Federal Reserve Bank of Richmond from 2004 to 2017. Jeff is in a unique position to comment on the efficacy and mechanics of the Fed's balance sheet management, having been at the table during rounds of QE through the financial crisis. I think it's interesting that he believes Fed officials misdiagnosed overnight funding market pressures in 2019 and the fourth quarter of last year. Although he may be correct that those spikes in short-term interest rates did not reflect a liquidity crisis that requires Fed intervention, it seems unlikely at this time that a majority of FOMC participants will come around to his view anytime soon. As a result, Kevin Warsh may have to settle for small tweaks to the Fed's balance sheet rather than returning it to its pre-financial crisis size. The next 2 weeks, financial markets will be focused on how the war in Iran evolves and any concrete evidence of its economic impacts. The ceasefire between the U.S. and Iran is set to end next week as of recording, but officials have expressed confidence there will be an extension so that the two sides can work out a longer-term agreement. Kevin Warsh will appear in front of the Senate Banking Committee next week as part of the approval process to become Fed chair. North Carolina Senator Thom Tillis still refuses to cast a crucial vote in support of Warsh until the Department of Justice wraps up its investigation of Chair Powell's congressional testimony last year. Tillis has expressed support for Warsh, but believes the investigation threatens the Fed's political independence. The data highlight next week will be Tuesday's retail spending report for March. Headline sales are expected to rise 1.2% because of the impact of the war on gasoline prices. Excluding autos, gas, and building materials, control group spending is expected to rise a much more modest 0.2%. The following week, the Fed will announce its latest policy decision on April 29th. Virtually no one expects any change in rates. Until then, FOMC participants are in the customary pre-meeting communications blackout. Also that week, the March PCE will be published April 30th, along with the advance release of first quarter GDP. Growth is expected to have rebounded after the government shut down depressed growth in Q4 of last year. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.